Understanding earnings reports. Earnings reports are one of the best ways to get valuable information about a company's business and its financial health. They are free and publicly available for investors to analyze. Don't be afraid of all the numbers. You don't have to be a financial professional to draw meaningful conclusions from them and the additional attached content. You just have to follow some basic rules and concentrate on the relevant information. There are also some accounting tricks that companies can and sometimes do use. In this video, we will go through the basic concepts on how to tackle these reports. Rule number 1. One data point is nothing. The first rule of thumb is that you should always look for trends instead of focusing on a single number, be it the revenue, profit, debt, or whatever fancy ratio. The evolution of the data is what counts. In stock analysis, there is a saying that trends last longer than anyone expects. In my experience, that is also true for company financials. If a company can outgrow its competitors for 10 years, it's most likely that it will fare better in the future too. That's not to say that things don't change. They do all the time. But my base scenario is always the continuation of the trend. Rule number 2. Benchmarking the numbers. For every analysis, you need context, period. Without knowing what to compare a figure to, you are lost. Let's take margin, for example. It's maybe the simplest way to get a glance at the efficiency of a business. But a margin number itself is close to meaningless. A company operating with a 20% margin might be an industry leader or a serious laggard. How will you know? Well, you must look at similar firms' figures too. And by similar, I mean same industry, roughly same size and comparable environment. The good thing is that for most developed stock markets, this comparison method is readily available if you know what to look for. A hint? In the financial jargon, the similar companies together are called the peer group for a given firm. Rule number 3. The devil's in the fine print. If you read the headlines of a report, you will always stumble upon great news. Even if the company is headed for bankruptcy, it will look like a turnaround is nigh, and in a quarter or two, everything will be rosy. You should treat the text as it is, a sales material. Behind a profit, there could be one-time events. Behind growth, there could be a fire sale. Again, mind the trends and ignore the headlines. Rule number 4. Look for the driver. In order to efficiently analyze a report, you have to concentrate your efforts. Every business has one or two key elements that should be at the center of your attention. Just to name a few examples, that could be active users for a social network, or revenue and margin for a hardware manufacturer. If you are new to stock investing, I and some others, including Warren Buffett, Benjamin Graham, who might even know better, suggest that you start your career with industries that you fully understand. This way, finding the driver or drivers will be a walk in the park, and you will have the confidence to move quickly forward on your learning curve. In the next video, we will look into specifics about earnings analysis.